Welcome to The Interest. I'm Ryan Kingsley. It's Halloween Eve, and the mortgage industry has clearly picked up on some of the scary vibes out there. Rates on the 30-year fixed mortgage surged past 8% last week, sending shivers down everybody's spines. Yikes. To give us some context about this unpredictable market, our friend, Bill Bodnar, shares some insight in this week's Master the Markets. And after that, our own Andrew Berman and Vincent Valvo return to the ring in another rendition of Cage Match. We'll have more on that later, but first, more than a decade has passed since the Great Financial Crisis, and in that time, independent mortgage banks, or IMBs, have supplanted retail banks in mortgage lending. I had the chance to sit down with industry experts to discuss the takeover. Here's the story.
They're making a decision based on their risk appetite, and that's a real thing, their risk appetite.
As banks pull back, IMBs have expanded access to homeownership for lower and moderate income and minority borrowers. An April report published by the Urban Institute's Housing and Finance Policy Center revealed that IMBs are dramatically outperforming banks, particularly in government lending.
There's one hint of reputational risk the banks run. So, for example, banks are not very involved in government lending, and that tends to be lower credit score borrowers.
Now, a widening homeownership gap and proposed modernization to the Community Reinvestment Act have raised the question of whether IMBs ought to be subject to a reinvestment mandate like their retail bank counterparts. Leaders across the mortgage industry say no.
IMBs are by far and away the first lender and the lender of choice for the very borrowers that a new CRA-like program is intended to support in the first place.
Even the authors of the Urban Institute report aren't convinced.
I'm not sure banks should be subject to CRA because they're already doing more. They're in one line of business. It seems like it's a solution in search of a problem.
The question becomes whether banks, or independent mortgage banks for that matter, have to be in the business of expanding access to homeownership. Whose job and expense is it?
I believe that we need to look and support and create structure for borrowers instead of for loans. I believe that we need to focus on the people instead of the package.
Read more about why independent mortgage banks don't need a CRA cramdown in the August issue of Mortgage Banker magazine at mortgagebankermag.com. For The Interest, I'm Ryan Kingsley.
My name is Thomas Hall. I went ahead and used the Southwest AI app, and I put in a difficult loan scenario with some tax returns and everything, and I had somebody else already underwrite it. When it came back, it was almost identical within like a few dollars, and it took about 30 minutes instead of a whole day or two for somebody to analyze that. So, yeah, that AI is going to be the best thing in the whole industry. So stay tuned.
Thanks for tuning in to our Master the Market segment. So last week it was quiet in as much as the Fed didn't speak, which is a good thing. Why? Because it was the blackout period before this week's Fed meeting, but the markets were not quiet. We had some treasury auctions that continue to put upward pressure on interest rates, right? So that's something that we're watching closely at Mortgage Market Guide. And then the GDP came out, third quarter to first reading, came out blistering, almost 5%, well above expectations. Durable orders were real strong. Those are items that are like refrigerators and ovens and big items. Those came out stronger than expected. And in the face of all of it, the bond market held near key levels, which is important for us. Why? Because ECB President Christine Lagarde decided not to do anything with interest rates, and she cited economic weakness. So there's a sense that we're hitting like what they call the terminal rate or the peak in interest rates around the globe. Let's hope so. Now, this week, obviously, it's Fed week. Come Wednesday, we're going to find out if the Fed does anything with interest rates. Right now, the market's saying there's no chance, and in fact, the markets are pricing in that there's no rate hikes. Why? Because we want to hear what they say about long-term rates and that spike. Obviously, it's hurting housing and mortgage significantly. So we'll be listening for that. Listen, have a great week, and we'll be talking to you soon. Bye for now.
All right, so Andrew, today we're going to talk about a cockamamie idea that you've come up with, or that you've heard about. This is, should mortgage loan originators, get a piece of the servicing revenue?
You've already pre-framed with cockamamie.
Yeah, that's right.
So
Yeah.
he's probably going to declare victory on this one already.
Go ahead. Why in the world does this make any sense to have loan originators take a piece of the servicing action?
Okay. So first and foremost, I think actually that borrowers sometimes are not happy with a process where they get sold and sold and sold. And, no originators talk about that as part of the origination process. And there are a handful of originators or servicers that are a part of originations. There was one actually that we saw just the other day that is offering originators a piece of actually.
Listen, how in the world does giving originators some commission or some dollar remuneration on the servicing make it so they're going to talk to consumers and say, this loan's going to get sold 5 times. I'm just telling you up front. How is that going to fix that situation at all?
So here's the thing. If I'm the servicer, I know actually that I can say to my originators, hey, listen, I'm going to pay you actually what everyone else is paying on the street, but I'm also going to give you something on the back, which that means actually that as that loan is being serviced, you're going to continue to receive almost like an annuity from us, which will keep you with us, will also actually keep you from
with them.
Keep the originator with the servicer.
The servicer's going to change 4 or 5 times throughout this.
They don't have to.
But they do. But they do.
For those servicers that have to.
The servicer does not care about paying more dollars out to the original loan originator.
There's plenty of servicers whose core business model is to actually retain and keep servicing and never get rid of it.
Not servicers. Lenders have that as a core business model. But frankly, listen, here's the thing. Those guys didn't even have it as core. Things change. We've seen so many companies decide they were doing one thing, then they said, let's get out of it.
Let's take advantage of this opportunity then.
I don't see that there's any advantage to a lender or servicer to send dollars back to the originator on this, whether it's a retail originator or whether it's a brokerage, an originator brokerage. I don't see how that helps anybody.
Okay,
it helps the originator.
It helps the servicer.
How?
Because it keeps actually the borrowers with them.
No, it doesn't. How does it keep the borrower with them? The borrower borrows, the originator originates the loan, the borrower has the loan, the borrower pays the money to whoever's servicing it. Whoever is servicing it.
So now,
whether it's here or it's the next guy or the next guy. And that's all determined by the lender who decides whether he's going to sell it. It has nothing to do with the originator. The originator has no role in that whatsoever.
You are talking about today's market, but I'm saying
tomorrow's market is going to be exactly the same.
Could you imagine this?
I can't imagine it. No.
Before you declare victory on this,
can you
imagine this? Imagine actually if your call to your borrowers wasn't to say, hey, are you ready to refi? It was just actually a service call saying, hey, is everything okay?
Oh, they could do that anyway. Are you saying that the servicers need to pay the originators in order to keep it in touch with their borrowers?
Now they have an incentive. Now they
already have an incentive. If they want to make
another transaction,
if they want to make another transaction, then they're going to do this.
That's their only incentive for another transaction.
The servicer is already being paid.
This is aligning.
Listen, this is a crazy idea. I know somebody's testing it out, but it's still a crazy idea. And on this one, listen, I declare victory. You're done.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.